Hello again, and welcome to the latest installment on the free financial educational website, Smart Financial Future. I'm John Williams, Certified Financial Planner, the creator of Smart Financial Future, and the founder of Ironwood Wealth Management. Let's get started. In this installment, we're going to talk about the mistakes we see even smart investors making in their 401k plans. You know, 401k plans are ripe for mistakes, and today we're going to cover 5 of the most common mistakes we see even intelligent investors making. Most people make their 401k decisions under less than ideal circumstances, such as right after they start their job, when obviously they've got a lot of other pressing matters in their mind normally. And despite the recent trend toward higher participant education and simpler solutions, 401k plans are still far from mistake-proof. Let's go over 5 of the common mistakes that even more knowledgeable investors might be making. Keep in mind, these mistakes don't apply strictly just to 401k plans. They can also relate to investors in 403b plans, 457 type plans, and other company-sponsored retirement plans as well. So, let's talk about the first mistake. I'm going to call it winging beneficiary designations. You know, we see people fill out their 401k beneficiary forms without a lot of consideration for the impact of what they're really doing, especially if they're young. Sometimes that can make it seem like just a simple, innocent legal document is easy to do, and that's what makes it vulnerable and can have unintended consequences. For example, if you're unmarried, you might be inclined to designate a brother or a sister or a parent as your beneficiary. And you think later on that person will distribute out your assets based on your wishes. Keep in mind, the beneficiary, first off, might be unaware of what your wishes are, but more importantly, they would have no legal obligation to share those assets with anyone else. Okay, mistake number 2, passing on funds that may not be a brand name. Just like many people tend to reach for Coke or Pepsi when they want a cola, knowledgeable investors sometimes naturally gravitate towards the names they recognize in their 401k choice lineup as well. There's really nothing inherently wrong with that. Funds from big 401k providers like Fidelity and Vanguard are the mainstays for a reason. But before you make your investment choices, be sure to also check out some of the investment choices you may not immediately recognize. Some fund lineups include options run by boutiques, that is, specialists who may specialize in a given style, for example, small companies or maybe international. Those lesser known managers might in fact be more nimble and more specialized in certain areas than some of those big boys. Mistake number 3, not readjusting to higher contribution limits. Investors in 401k plans who maximized their 401k account contributions 5 years ago might not be doing so now. That's because not only have contribution limits trended upward, but participants over age 50 are now able to make an increased catch-up contribution. So that way you can sock away even more as your retirement draws closer. The contribution limit for investors under age 50 is $17,500 for 2013. You can also make an additional catch-up contribution of $5,500 for a total of $23,000 if you're over 50 years old. Keep in mind that you can start making catch-up contributions at any time during the year in which you turn 50. You don't have to wait until your birthday. So let's talk about mistake number 4, missing out on matching dollars, right? Not taking full advantage of your employer's contributions is one of those typical mistakes you might think only applies to someone who's a novice investor. But it doesn't just happen when you forego your 401k contributions altogether. You can also very easily miss out on part of your match if you're contributing the maximum allowable dollar amount in your plan. That's right, listen up. If you contribute so high that you hit the maximum allowable contribution well before year end, you'll miss out on additional contributions that your employer might have made had you have contributed throughout the course of the year. Now, this can be a particularly big problem if you're lucky enough to receive a large bonus in the first half of the year and part of your bonus gets paid into your 401k plan. The key here is to contribute your maximum allowable amount while still maximizing your match. Okay, let's talk about mistake number 5, and that is trading in your 401k too frequently. You know, investors in tax-sheltered accounts, when compared to taxable investors, they don't get dinged on taxes from one year to the next, nor do 401k investors typically face commissions to buy and sell, but keep in mind, they may face redemption fees if they trade too frequently. All this gives 401k investors the perceived latitude to trade to their heart's content because they don't have few tax or transaction costs. That obviously can make it very tempting to trade frequently, buying and selling, putting more money into funds that have been doing well, etc. But just because that kind of trading doesn't carry what we'll call readily quantifiable cost, that doesn't mean it won't impact your returns. With a lot of activity, you'll increase the likelihood of timing-related mistakes. Morningstar Investor Returns quantifies how much investors shortchange themselves with mistimed trading. And believe it or not, those costs can be substantial. Okay, I know I said this was going to be the 5 mistakes that even knowledgeable investors make in their 401ks, but I'm going to give you an extra one. It's a bonus. Not complaining about a lousy 401k plan. One of the most frequent 401k mistakes participants make is to take a lousy plan lying down. Now, rather than complaining about your plan with your co-workers, around the water cooler and so forth, what you probably ought to do is document your plan's drawbacks in writing. Ask some of your colleagues to do the same, and then share that information with your benefits decision maker at your firm. At smaller companies in particular, 401k plans might be overseen by people who don't have such a deep background in investing matters, so they may actually welcome your feedback. This has been John Williams with the free educational website, smartfinancialfuture.com. Don't hesitate to let us know if you have any questions. We'll see you next time.